Hello, friends. We have just entered the new financial year. Over the next few minutes, we discuss some of the key events of the recent past related to the Indian equity market and also present our views on the market outlook. The month gone by was quite eventful. The Brent crude prices moved towards $140 per barrel during the month and retraced sharply towards the end of the month. Most commodities also witnessed sharp increases during the month. The US Fed finally hiked the interest rates by 25 basis points and signaled further hikes going forward. The US 10-year Treasury yields firmed up by about 50 basis points, while the Indian 10-year bond yield moved up marginally amid increased geopolitical tensions due to the continuing conflict between Russia and Ukraine. On the local front, we also saw state election results coming through and thereby removing overhang on the equity market. The Indian equity market movement during the past month belied the volatility caused by relentless selling by foreign institutional investors and sharp price moves seen across most commodities globally amid continuing global tensions. The Nifty 50 index went up by about 4%, while mid-cap and small-cap segments fared even better with 4.8% and 6.2% gains during the previous month. On the global front, the fears surrounding high inflation and its adverse impact on global interest rates seem to be unabated. We have seen inflation fears dominating the markets, and the yields have firmed up across the globe in recent weeks. The disappointments of late reflect an intensification of manufacturing supply constraints and an inflation surge that have taken a heavy toll on the goods demand. On the domestic front, economic activity and macro indicators showed mixed trend. While the COVID concerns are on the wane and the recent GST collections crossed record levels of rupees 1,42,000 crores, GDP estimates for financial year 23, however, witnessed downgrades and current account deficit widened to 2.7% of GDP in the third quarter, the highest level seen in 9 years, driven by the impact of soaring global commodity prices. The external sector matrix remains vulnerable from uncertainties arising from geopolitical risks, differential pace of policy normalization by central banks. Recent conversations have centered on corporate margins and their profitability given the prevailing context of commodity prices post Russia Ukraine war. Overall, we believe the next 2 quarters are going to be seeing a sharp margin impact and corporate commentaries will worsen before it gets better. Secondly, while the Nifty has not seen much earnings downgrade so far, thanks to upgrades in metals and oil and gas and neutral to no impact in IT and BFSI sectors, the broader universe is clearly bearing the brunt of commodity cost inflation, a trend we witnessed even in the previous quarter. That said, if the input cost situation do not improve and price increases become inevitable, we are not too far away from some demand dislocation in an already weak economy. And this, at some point of time, may manifest in earnings downgrades, even for the Nifty in our view. As far as our portfolios are concerned, we continue to focus on economic recovery plays and consistent compounders that have room for higher than average market earnings growth, as well as possible valuation re-rating. On the valuation front, currently, the large cap indices seem to be trading above the fair value zone. While we remain positive on Indian equities, we also recognize that the current valuation levels do not leave much room for any negative developments or disappointments. The delivery of earnings on expected lines will be very crucial for sustenance of current market levels, more so for mid and small caps. As far as how to go about investing in equities now, we believe that One needs to follow time-tested principles of regular investing and long-term focus. With expectations of continued volatility in the short term, we advise equity investors to make disciplined and regular investments with long-term focus and also utilize periods of volatility to build on long-term portfolio at better valuations. We continue to be positive on the corporate earnings cycle over the next few years, despite fears of disappointments in the immediate term. We advise investors to have a slight tilt towards large caps and look at mid and small cap strategies only from an overall cycle perspective and have an investment horizon of at least 3 to 5 years. Let me end by wishing all of you a very prosperous new financial year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.